Welcome to the benefits webinar this afternoon. My name is Brandy Pardo, and I am a senior account executive with Apex Benefits. Today I'm partnering with Kinetic Health to bring you some information on understanding tax advantage health accounts. Before we begin, some webinar housekeeping. All attendees will be in listen-only mode for the duration of the webinar. For questions or comments, use the chat box located on the right-hand side of your webinar screen. Presentation slides and resources can be downloaded on the right-hand side of your webinar screen. Okay, well, let's just dive in. On the agenda today, we are going to talk about tax advantage health accounts, why they matter, the types of accounts, the flex spending, and there are a few types of flex spending accounts, health savings accounts, health reimbursement arrangement, and then some of the key benefits and differences between them all. So what are tax advantage health accounts? Well, they're accounts that provide a pre-tax benefit for your medical expenses. That is, they come out of your payroll deduction pre-taxed, and then you can pay for those medical benefits with those pre-tax dollars, therefore cutting down on the amount of money that you're taxed at the end of the year. They help reduce your overall healthcare costs by being pre-taxed, and they often are paired with special health insurance plans, some more particular than others, and they encourage savings for the current and your future healthcare needs. So the main types of accounts that we see are flex spending accounts. Those are our use it or lose it accounts. The health savings accounts, that's the triple tax advantage, and the health reimbursement arrangement, and those are the employer funded accounts. Let's talk about plan correlation. So what type of medical plans can utilize which tax advantage health accounts? There are PPO plans, and those are your copay plans, and then there's high deductible health plans. And that's when the member has the first dollar responsibility before the copays kick in. So for the PPO plan, you can have access to the general purpose FSA, the dependent care FSA, or the limited purpose FSA. Some organizations also or will have a health reimbursement arrangement. For the high deductible health plans, you can also have access to dependent care FSA or the limited purpose FSA and contribute to a health savings account. And again, an employer may decide that they want to put in a health reimbursement arrangement, and that can also be utilized with a high deductible health plan. Flex spending accounts. So flex spending accounts are an employed sponsor account. All your contributions are pre-taxed. It is a use it or lose it. So whatever money you put into that account, you must use, or you lose it. You're not able to carry that over. You're not able to keep that year over year. Typically, it must be used within the plan year. Sometimes there's situations where there's a rollover, where you can roll over a certain amount into the next plan year. But for the most part, these accounts must use those dollars within that plan year. The payroll deduction that you decide at the beginning of the plan year for the calendar year, it can't be adjusted or changed throughout the plan year. This is a non-portable plan. The FSA, you cannot take it with you if you leave employment. Those dollars belong back to the employer. And there's limits to the contributions that are set by the IRS, and those change annually. So flex spending accounts cover many out-of-pocket medical expenses. They have lower limits than that of a health savings account. You do have immediate access to the full annual election amount. So this is where we go back to, once you choose how much you're contributing each pay, you can't make any adjustments to that contribution because you have immediate access to all the funds that you've planned to pay throughout the year. This is great for predictable expenses. If you know you have a surgery coming up, or maybe you have a hospital bill that you're paying on monthly, and you know that you have $2,000 that you need to pay on that for this year, you can divide that $2,000 up into individual payment amounts for your payroll deductions, but then go ahead and access those funds immediately and pay that amount. The IRS guidelines and limits for 2026 annual contribution limit is $3,400. The carryover limit is $680. Now again, not all plans have carryover, so you'll just have to check with your administrator if that's something that's allowed or not. These are the same IRS limits for the limited purpose FSA. Now, flex spending accounts, we have dependent care FSA and also limited purpose FSA. Dependent care FSA is specifically used for eligible dependent care services. Now, that could mean that you have child care expenses that you need to utilize with that, or maybe you have an adult parent that you take them to an adult dependent care, and you can utilize those funds through that dependent care FSA. Annual contribution limit is now set at $7,500 for singles and for married couples filing jointly. A limited purpose FSA specifically uses these dollars for either dental or vision only. You can only use them for expenses that are dental or vision. The annual contribution limits are the same as a general FSA. However, employees may set up plan-specific limits below the IRS maximums and determine allowances for carryovers. So while this is all great, you can save your dollars. Everything is different dependent upon how your employer is setting up those plan contributions and the rollovers. Okay, well, now let's talk about health savings accounts. And this is one of my favorite things to talk about because you can go so in depth and there's so many things that you can utilize a health savings account for and in so many different ways. But this is a great pre-tax deduction that you can utilize for your medical, dental, or vision expenses. The health savings account is available with qualifying high deductible health plan. You cannot be enrolled in Medicare, Medicaid, TRICARE, or VA benefits within the last 6 months to contribute to a health savings account. You must not be enrolled in any other non-qualified medical coverage through another carrier or another family member. You and your spouse cannot be contributing to or participating in a general purpose FSA through an employer. You cannot be claimed as a dependent on another person's tax returns. And HSA usage for dependents is allowed even if it's only self-contribution only. So let's say that you have your medical benefits set up with your high deductible health plan, your HDHP, as employee only. You can contribute up to the allowed amount for the year, the maximum of $4,400. You cannot contribute the family amount, only the individual amount. But for those members in your household, maybe your child is covered on your wife's health insurance, to pay for any of their expenses, doctor's visits or anything like that, you can utilize your HSA dollars because you're in the same taxable household to pay those medical expenses, even though you're only contributing for single. There's a triple tax advantage. So you pay no taxes on the money that you contribute, you pay no taxes on the interest that you earn, and you pay no taxes on the money you withdraw so far as the funds are used for qualified medical, dental, and vision expenses. Those funds accumulate and roll over year. They belong to you, the employee. So if your employer makes a contribution, $1,000 every year, and puts that into your HSA, if you should leave employment, those funds belong to you and they go with you. With that, the allowance for adjustments and contributions at any time throughout the year is allowed. So at the beginning of the year, you decide you want to contribute $100 in your payroll deduction, but as you're getting up to the end of the year, you realize that you're not going to max out your contributions and you want to do that. You're allowed to increase those contribution amounts so that you are maxing out your contribution by changing that payroll deduction. Same goes on the other end. Maybe at the beginning of the year, you're putting in $150 per pay, and then something happens mid-year and you need that extra $150 in your paycheck. You can stop contributions at any time, and then pick them back up if you want to do that. The health savings account sets IRS limits. Those are changed annually. The individual limit for 2026 is $4,400 for self only. For family, the limit is $8,750. And family is anything that is employee plus. So employee plus dependents, employee plus spouse, or your children and your spouse. Individuals over the age of 55 can contribute an additional $1,000 as catch-up contribution. Now, the IRS's thought processes on this is as we get closer to Medicare age, that age 55 to 65, we figure out that we really need to bank some more money into our HSA account for our retirement plan to help in those contributions. So the IRS has allowed us to put an additional $1,000 so that we can catch that account up to help out with those retirement expenses. With that, an individual would be $5,400 this year as the limit if you're over the age of 55. The employer contributions may apply. So take into consideration that if that annual limit is $4,400 and your employer contributes $1,000 each year, then your contributions or your payroll contributions cannot exceed $3,400. If you have questions, as always, make sure that you are going to your administrator for the HSA or someone in HR so that you're not going over those contribution limits. Okay, so a health reimbursement arrangement. Health reimbursement arrangements are put into place by employers to help offset some costs as the employee. So they are employer-funded arrangements. The employer controls the amount of funds that they allow for this arrangement or what they're going to help you and cover in expenses, whether that's cover partial deductible or cover the full deductible. So they control what they put into that account for your usage. They also control the reimbursement model. So the employer-funded designs are there to complement your medical plan. So if your medical plan is set up, maybe not a PPO where there's copays, but you have a high deductible health plan, and the employer puts in an HRA or that health reimbursement arrangement so that they're paying the first portion of your deductible, or maybe you're responsible for $2,000 of that deductible, and then the employer's picking up the rest on the back end. This is how the employer funds that. That's part of the HRA. They design on how the money is accessed or how it's distributed, whether that's upfront or on the back end. There are a lot of vendors out there that they can utilize that utilize a card. So you would have access to a Visa or a MasterCard that you could swipe for either first dollars or back end dollars to help pay for those expenses, either upfront or on the back end. Sometimes that reimbursement model, depending on the administrator, again, could be a card that you use, a credit card that you use, so it would be at point of sale. So while you're at the doctor's office, you swipe the card and it pays for that copay immediately, or it pays for that bill. The same at the pharmacy. You go to the pharmacy and there's a cost to your medications. You're swiping the card and it's at point of sale there at the pharmacy. Other times, the administrator can set this up as a claims feed. So maybe you have a deductible model in place where your portion of the HRA arrangement is the first 2,000. After that, the HRA is going to pick up. They will set up claims feeds that go to or through your carrier. And then once you've hit your portion of the deductible, the carrier feeds will feed through. The HRA sees that you've hit your deductible that's been set aside by your employer. And then they will start to pay your provider claims directly to your provider on the back end. So then you no longer have out-of-pocket expenses. There's also a reimbursement method where you're swiping and paying for those claims up front, whether it's a prescription or an office visit, and you're sending in that authenticity or that verification back to the administrator, and then they send you reimbursement. Many ways you can set this up that's advantageous to saving dollars, again, pre-tax dollars, but these dollars at the end of the year, if they're not utilized, then they go back to your employer or they stay within your employer's funding mechanism. So any dollars not utilized by you doesn't come back to you. It belongs to the employer. So what are some benefits of these accounts? Well, obviously the benefits, since they're tax advantage benefits, is that it reduces your taxable income. A lot of these things that happen on the back end or monies that you're putting aside are pre-tax dollars. So you're not taxed on those dollars when you put them aside to utilize them for your medical, dental, or vision expenses. And you're not taxed on them when you do utilize them for those medical, dental, or vision expenses. So that really lowers the out-of-pocket healthcare costs in general, again, because these dollars aren't taxed. It encourages savings, discipline to savings. So for that HSA account that you're looking to put those dollars back in for further advantage or further use down the line, it's going to drive you to want to save those dollars to make the biggest bucket possible when you really need to use those, which is during your retirement years. HSA can act as a long-term investment tool. Again, this is one of those things that different HSA administrators will allow you to invest your dollars once you've reached a certain threshold. Those investments can gain interest. That interest can build over time. You're not taxed on that interest. You're not even taxed on the funds that you pull back out of it if you have invested it to use on anything medical, dental, or vision related. So essentially, you can put your dollars into your HSA account and invest them, gain interest on them for a later time. And that's why we're talking about this being a long-term investment tool. I tell people nowadays, if you can bank as much dollars into your HSA as possible, not pulling those out for anything current, being able to utilize your own dollars that are already taxed, your taxable dollars, to pay for your current medical expenses, if you can afford it, leave those dollars in your HSA account because it's just another pre-taxed account that you can use later on down the line. So common mistakes that are made are not contributing enough to our HSA account. You start early, you maybe as a young adult, you really don't make as much dollars as you would like to in your payroll deductions, so you don't think that you can afford to take out more money and not really be able to utilize it when you do have healthcare expenses. But the earlier you start in building your HSA account so that you can utilize it later on, the better. Even if that means it's only $10 per pay right now or $25 per pay right now versus maxing the whole contribution amount by the end of the year. Losing FSA funds due to poor planning. If you don't really have planned medical, dental, or vision expenses throughout the year, You don't have that braces plan that you're going to have to pay on for some of your children. You don't have any surgeries coming up. And you have a very affordable PPO plan that you only go to the doctor 1 or 2 times a year. Putting funds into an FSA account where you are going to use it if you don't lose it is not going to be advantageous for those pre-tax dollars. Using HSA funds too early instead of investing them. So again, if you can afford your medical expenses now with regular tax dollars and keep those pre-tax dollars in there for more investing, it's better to do so instead of pulling those out and utilizing them for small things. And then not really understanding what eligible expenses are, not accessing your online tools, that fsastore.gov or the HSA store, spending those dollars in the right place could cause you some penalties at the end of the year if you're ever audited by the IRS, and not keeping your receipts or being able to adjudicate those claims if there's ever an IRS audit. What are some smart strategies that you can do? So, first and foremost, if you have access to an HSA account and you're on a high deductible health plan, maxing out those HSA contributions every year if at all possible. So, put as much in there as you possibly can and leave it alone. Then, if you have access to be able to invest those funds, invest those. Invest them as much as you possibly can and let that draw interest. We know that life sometimes happens, and those HSA dollars are yours. They're portable, they belong to you. Even what's contributed by your employer, those are your funds. So if life happens and you have to pull funds either out of your HSA account or maybe out of investment because you had something major happen, you had your car break down and you need $2,000 or $3,000, you can utilize those. Those are your funds and they do belong to you. But what you have to do is make sure that you're claiming those funds on your taxes because they will be taxed at the end of the year. You have to show it as an income. Because you didn't use it on qualifying medical, dental, or vision expenses, you do have to pay taxes on it, so therefore there's a penalty. But if you invest those funds for medical, dental, and vision expenses, and you have to pull it out of investments because you had a rotator cuff surgery, or you need to pay for your child's braces, then there's no penalty for pulling it out of investments as long as the funds are used for those qualified expenses. Invest those HSA funds again for long-term growth and keep receipts for future reimbursements. So as long as you're keeping your receipts for medical, dental, and vision, you can actually reimburse yourself at any time. Those particular things that you've had for medical office visits or surgeries or dental visits, you can use those receipts to reimburse yourself back, or making sure that you're keeping those receipts in case of a tax audit. One step further with an HSA retirement tool. Your HSA dollars can be used after the age of 65 for non-medical expenses, but it is taxed like an income. It also covers your healthcare premiums for supplemental plan in retirement. So when you've banked all this money into your HSA account, why we keep saying it's a great retirement tool is that although you cannot use those HSA dollars to help pay for medical premiums prior to the age of 65, once you've reached age 65, you can use those HSA dollars to help pay for your Medicare supplements, your Part D supplement, EC, GF, what all those supplements are for your medical prescription plan or additional plans for surgeries and hospitalizations. So that is a great tool to help offset some of those costs once you reach that 65 Medicare eligible age. I wanted today to put in a little chart here that you can utilize as a resource. What the feature was of the things that we've talked about, the HSA account, the FSA account, and the HRA account, and how those are utilized. So the ownership of the HSA as individual belongs to you. The owner of the FSA is employer as well as the HRA. Rollover. Do these accounts roll over? So the HSA, yes, it rolls over year. FSA, there could be a limit rollover amount. And the HRA is actually the employer's funds. Now, they may decide that a small amount or a certain amount can roll over into the next plan year, but they don't have to do that, certainly. And all of those funds actually belong to them that are not utilized. Portability. Can you, as the employee, take these funds with you should you leave employment? The short answer to all of this is yes for an HSA, no for the FSA, and no for the HRA. Again, the funding. Funding for an HSA is you, the employee, and employer contributions if they give in contributions. The FSA is employee-only contributions, but you lose the funds if you do not use those funds. And the HRA is employer-only contributions. You don't contribute to this, only your employer does. But again, if you don't utilize them, they stay with your employer. And can you make investments on the funds that are contributed? So for that health savings account, of course we want you to make investments with your dollars. Grow interest and be able to have extra money when it comes time to retire. FSA is a non-investment plan, and HRA is also a non-investment plan. There are some guidelines and some resources out on the internet. The IRS website has all things tax favored health plans. If you go to that publications P969, it will list out chapter after chapter of things that you can do, things that you can't do, and some guidelines that are set within the health savings account or any of the other tax favored plans. The FSA and HSA store is a great resource. When you pull it up, it actually has both stores there, just two little tabs that you can click on. But if you're looking to find out if the items that you want to purchase, either over the counter or online, maybe Amazon.com has that HSA store that you can look through. Those are guidelines that you can see whether it's an item that you can purchase and it's qualified, or if it's not listed within those qualifying items. Certain DMEs or knee wraps or bandage wraps, those kind of things, are they a qualified expense? Are they not? So it's great to utilize those resources. Get online. If you have questions, as always, make sure that you're going to the administrator of your HSA, FSA, or HRA, and or your human resources manager. They're going to be your best resource when you don't understand or these things get complicated. And then your broker partner, Apex Benefits, we're always here to answer questions and to talk through these things. These are all things that we talk through throughout the year, especially during open enrollment season. But the off seasons, when you really utilize those dollars. So take the webinar, share it with a friend, share it with a coworker, take it actually off the internet and sit down with your spouse and talk through these things if your spouse is unfamiliar. It's a great tool and a great resource. I'm Brandy Pardo, again, account executive here at Apex Benefits, and we love talking through all these education things that are going to help you be a better consumer of your healthcare. Thanks for hopping on today, and have a super great day.